Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group. Welcome to another episode of InFocus. Today, we're going to get a quarterly update on our income-producing portion of our portfolio, and joining me is Nick Leach, the PM responsible for this sector. Welcome, Nick.
Good morning, Mike. Good to be here.
Great to have you. So, let's dive into it. As we always talk about our income producing, the first thing we focus on is interest rates. And so, in the U.S., the Fed finally moved. I know we usually talk about Canada, but why don't we start in the U.S. first and talk about that?
Yeah, it was the first move in September in quite some time. They've been lagging the rest of the central banks globally. So a 50 basis point cut is rather unusual. Conventionally, it's 25 basis point cuts. The 50 basis point cut, it's usually reserved for a financial crisis or a pandemic. So this was a big one. And it was a little bit unexpected because it was 50 basis points, in the U.S. But on the other hand, the market had been expecting a 25 basis point cut in the July meeting, and that never happened. So I think the Fed was doing a little bit of catch up there.
For sure. Switching gears a little bit to Canada. Again, they continue to drop, correct?
Yeah, and again, 50 basis points, another unconventional move. But it was a little bit different in Canada because in Canada it was widely expected to be 50 basis points, even though the previous 3 basis point cuts were 25 basis points each. So the market was largely expecting it, and the reason for that is you had the central bank dovish guidance, and you've had much lower inflation. Inflation actually below the Bank of Canada's target.
Right.
Hence the 50 basis points.
So you mentioned then in terms of what the market was predicting, how are the markets reacting to the interest rate cuts?
Not as you would expect. If we look at the it's typical to look at the 10-year bond yield in Canada and in the US. The 10-year bond is just considered the bellwether for the entire market. So in the US, it hit a 1-year low of about 3 3/4 in September, and then we had the rate cut, and it jumped to around 4.2, 4.3%. In fact, the whole US yield curve jumped up, like everything greater than a year, right? Like 2 to 10 to 5s, they all jumped up, and you could argue that that might have been because the U.S. unemployment rate ticked down in the last couple of readings. It had been rising throughout the year, and then it ticked down, and then with the Fed finally cutting rates, those short-term variable rates, they could be considered somewhat stimulative for the economy. And then you could say that the bond market rally might have been overdone prior to the cut. But I think what's important here is you have these U.S. elections, right? So it's creating a lot of volatility in the bond market. There's a lot of political noise. And as that election date approaches, you've got all these inflationary campaign promises coming from both parties. So I think that has a lot to do with it as well, right? Because we're a week before an election, less than that, actually.
Yeah, and well, actually, it's interesting. Let's talk a little bit about the election. Do we have a position on this? Obviously we don't have a horse in the race, so to speak, but do we have any beliefs that, oh gosh, if Trump wins or Harris wins, there's this talk of a Trump trade, for example. But, what's our view on something like that?
Well, the thing is if we look at, do we have a horse in the race? You could say we do, because historically, the Canadian bond market, the 10-year bonds yields in Canada, very highly correlated to the U.S. Right? So even though the Bank of Canada cut, we still saw yields at 10-year yields in Canada increase, right? After that rate cut. So 10-year yields were under 3% in September, and then they jumped up to 3.3%. So how much of that was politics, political noise, campaign promises, inflationary campaign promises in the U.S.? I don't know. It's hard to compartmentalize, the effect of, the politics versus the inflation versus the employment situation. But yeah, Canadian yields are really driven by what's happening to the U.S. Yeah, we can't escape it.
Yeah, and so to your point, absolutely. We do have a horse in the race from that perspective, but in terms of, let's say, Trump versus Harris and policies
Yeah.
and the like, back to our process and the like, I correct me if I'm wrong. We're not putting any bets on one
No,
versus the
no,
other, right?
no,
Yeah,
no. And even if you could predict the outcome of a political election, you can't predict the market's reaction to that outcome. And we saw that with previous elections. We saw that in England with Brexit. Like we just don't know what the outcome is going to
right.
be or how the market is going to react. We would never speculate on a political outcome, for our investors. And we do have, our strategy has always been short-term corporates. So there's lower duration risk. If there is a lot of volatility in the bond market, the shorter term bonds are less volatile.
Right. And that makes sense. And it's interesting, as time, first of all, it's good that, as you watch the campaigns progress, it's interesting, even though, and without taking sides, one is more crazy, call it, than the other, whatever.
Yeah.
But at the end of the day, if you actually look at the policies, I'm not sure you actually see a heck of a lot of a difference. You talk about, say, protectionism. Well, gosh, the
Yeah.
Democrats are pretty damn protectionist as well.
Yeah.
And so, it's not abundantly clear, Canada is in any better shape of one versus the other from an economics perspective. So
Yeah.
anyway.
And it's not just the presidential race too. It's the House and the Senate.
Exactly.
We don't know how the outcome of that.
Exactly. That's a really good point. We sit there and focus so much on the presidential side of things, but the truth is, especially in the American system, their political system, it's checks and balances to the point that, nothing may change in terms of no matter who's in the White House. So yeah, really good point. So you talked about the changes. So let's talk a bit about the yield curve. Again, that difference between short-term versus longer-term rates and, how the market is reacting. Are we getting back to call it a more normal, getting out of this inverted yield curve trend that we've had for a while?
Yeah, it's finally normalized, but it's relatively flat. So it was inverted for 2 years, and that inverted yield curve was, a lot of people were concerned about a recession. Typically, an inverted yield curve is a good predictor of a recession, and we didn't see that. But now the yield curve has normalized. And when we look at the yield curve, the common frame of reference is the 2s and the 10s, the 2 years versus the 10 years. So right now in Canada, it's the 2s are at 3.1% and the 10s are at 3.3. That's relatively flat, but it's not inverted. And then similar to the US, you have the 2s at 4 and the 10s at 4.2. So again, it's no longer inverted, but it's still upward sloping. What is inverted is the very short term, right? Because if you look at the policy rates, in the U.S. it's still 5% overnight rate, but a 4% 2-year yield. So that area of the curve is still inverted, but that should normalize as well. We are expecting further policy rate cuts. So as those rate cuts do come down, we should expect that to pull down the shorter term 2-year yields. That hasn't happened in the last couple of months for all those reasons we've just talked about, but that's what our expectations would be.
So then, you said the R word. I didn't. You said it. So the recession. Back, it's interesting to look at the yield curve from a longer term perspective versus, as you say, the very short term. So, any thoughts on possible recession or not? Very short term?
Well, my background has always been in credit, right? Corporate credit. And we could talk about corporate credit spreads now because I think corporate credit spreads, those are really indicative of an upcoming recession.
All right. Let's shift there.
And we're not seeing that. Corporate credit spreads are very tight, almost near historical levels. And that's in Canada and the US, looking at investment grade credit spreads. We're 75 to 85 basis points. Typically we're, looking at 130, 140. So we're very tight. And even the US high yield market, which includes a lot of Canadian high yield borrowers, those are at very tight levels as well, around 300 basis points. So those are that's not indicating any type of recession. If you go back to the financial crisis, there was a credit bubble that caused a recession, if you recall, back in 2007, 2008. Sure. But I don't see a credit bubble because if you look at it all in borrowing costs for the corporations, like in the U.S., the effective yield for the entire investment grade market is around 5%, right? So it's lower than the 6.5% we saw a year ago. But it's still materially higher than the 3.5% that we've been seeing for the past 15 years. So it depends on your time of reference, but borrowing costs are quite a bit higher than they have been for the past 15 years. So I don't see it's like an easy money credit bubble coming up.
Right, for sure. So basically, sounds like, again, we don't necessarily like to put a lot of faith in predictions, but to your point on the corporate spreads, people are still feeling comfortable from a risk perspective that the spreads are so narrow.
Yeah, absolutely. And given the volatility in the treasury markets and the Canadian bond markets, we have seen, as I said, government bond yields are higher than what they've been for the past, 15 years. And that has not crowded out, any demand for corporate bonds.
Okay. That's good to know. So preferred shares, what are we seeing there?
So yeah, the preferred market, just as we talked about in our last podcast, it continues to be one of the better performing asset classes. Very strong returns, up 19% year to date, up 29% in the past year. Now that includes around a 6% dividend. And what's going on there? The market is dominated by these fixed 5-year reset preferreds, and with the 5-year Government of Canada bond yield again higher than it was 5 years ago, we're seeing a lot of these issues reset at a substantially higher dividend rate than what investors have been used to. And so the market is pricing in further dividend increases, because if you go back 4 years ago, the Government of Canada bond yield was less than 0.5%. So you had some of these preferred share issues resetting at, say, a 200 basis point spread over a 0.5% 5-year Government of Canada bond yield. Now that Government of Canada bond yield is, closer to 3%. So yeah, we are seeing these resets kick in. The market is pricing it in. So the issuers have the option of redeeming them for cash. They don't have to pay that higher dividend. But if that happens, then you have lower supply, right? Which is also supportive for these prices, right? Technically. Yeah.
Right. Okay. So looking forward, given the changes that we've seen from the Fed and the continuing trend, any changes? Are we making any adjustments to the portfolios?
No tactical change. We're still on that strategic allocation to 1 to 5 year corporates. The yield right now is 3.75% to 4%, depending on if it's 1 year or if it's 5 years. It's actually getting a little bit more yield on the shorter term because of we discussed those policy rates. And then the corporates, the prices, the average corporates for the entire market for the 1 to 5 years is now at par, or in some cases above par. But we can still find a lot of low coupon bonds that are still at a discount. So the bonds that we've been buying for our clients are still at, somewhat of a discount. So that's a tax efficient,
right.
That's very favorable in terms of taxes, and the capital gain portion is still quite a meaningful component of that yield to maturity. Not as much as it was a year ago, but still in good shape. And if we talked about the yield curve being so flat, so if we go from, 5-year bond extending out to 10, like pick up an extra 20, 25 basis points and just take on more duration risk. So I don't think it's worth it.
Right. Nick, thanks so much for this.
Oh, my pleasure.
Folks, as always, if you have any questions about what you heard or really anything in terms of your portfolio, don't hesitate to reach out to your TriCert Investment Counsel portfolio manager, talk to your CPA advisor, or don't hesitate to reach out to myself. Take care.